President Cyril Ramaphosa's office has seized control of the restructuring of state-owned enterprises. This puts the weight of expectations on the shoulders of the Minister of Monitoring and Evaluation, Ramaphosa. That's after Ramaphosa got rid of the Public Enterprises Department in a bid to consolidate the shareholding of strategic SOEs into a state asset management company. Ramaphosa will be responsible for setting up the holding company. The state will be the sole shareholder of the asset management company, but the door is open for strategic equity partners to be brought into the underlying SOEs. Some of South Africa's richest families have emerged as mega political donors. Several members of the Oppenheimer family donated a total of nearly 50 million rand to the DA and were also generous to Rise Mzansi, IFP and Action SA. Capitec's founder and largest shareholder Michiel Leroux donated 65 million rand to the DA. Action SA received significant support from Martin Moshal, who reportedly owns a stake in gambling giant Betway. And Corporate SA also got in on the action. African Rainbow Minerals and Harmony Gold have made financial contributions to various political parties since the 2021-22 financial year. These include the EFF, Freedom Front Plus, the DA and the ANC. The lion's share went to the ANC with an allocation of about 26 million rand from both companies. Naspers, in the meantime, took a liking to the DA and ANC, donating 10 million rand to the parties during the same period. All in all, businesses and the country's wealthy individuals and families have donated more than 300 million rand to political parties in the past 4 years. SARS and Woolworths are at loggerheads. That's over the tax treatment of imported services it procured in 2014 to raise funding to buy Australian retailer David Jones. The structure of the deal was such that Woolworths was funded by a combination of existing cash, new debt facilities and equity funding raised by a rights offer. For the purposes of funding the acquisition on completion, an equity bridge facility was secured and was repaid with the proceeds of the rights offer. 6 months after, Woolworths incurred expenses related to services supplied by local and non-resident service providers in respect of the rights offer. The group's tax advisors said that there was the potential for the firm to claim input tax on certain amounts paid. The retailer was also advised that it was entitled to claim an input tax credit on the acquisition of the shares in David Jones, and it would also be liable for output tax on imported services from non-resident, non-VAT registered suppliers. Woolworths duly submitted its VAT returns as per the advice it got, but SARS rejected the approach and slapped the company with additional assessments and levied penalties on the group for understating its taxes. SARS's argument is that the rights issue and expenses related to it form an isolated activity, and that the services rendered in respect of the rights offer were not rendered wholly for the purpose of consumption, use or supply in the course of making taxable supplies. The tax court has ruled in Woolworths' favour, and SARS has appealed against the decision. The matter is set to be heard before the Supreme Court of Appeal later this year. Oando has missed a deadline to release its financial results again. This time it's the Nigerian energy company's 2023 audited financial statements. The firm had expected to file these statements by July the 31st. It's now targeting the end of September. In April, Oando's shares were suspended by the JSE due to its inability to meet the extended deadline to publish its 2022 audited year-end results and its interim results for 2023. On the international front, China's BYD has opened an electric vehicle plant in Thailand, the automaker's first factory in Southeast Asia, a fast-growing regional EV market where it has become the dominant player. Here's more detail in this package report.
Step inside BYD's first electric vehicle plant in Thailand. It's part of the Chinese automaker's plan to expand in Southeast Asia, where BYD has become the dominant player. BYD CEO and President Wang Chuanfu.
We are convinced that Thailand will have a golden development period for new energy vehicles. China and Thailand are geographically close, culturally close, and economic and trade cooperation is booming. New energy vehicles are not only a bridge between China and Thailand to enhance friendship, but also a link between BYD and Thailand.
Thailand is a regional auto assembly and export hub. The country aims to convert 30% of its annual production of 2.5 million vehicles into EVs by 2030. Chinese EV makers clearly like the lure of the Thai government's subsidies and tax incentives. They've invested more than $1.4 billion setting up factories in the country, with BYD's new plant the latest addition. The sprawling facility is worth $490 million, and it will have a production capacity of 150,000 vehicles per year, including plug-in hybrids.
It will provide over 10,000 jobs after reaching full capacity.
As part of its expansion outside China, the world's largest EV maker is also building its first European base in Hungary, although BYD could feel some pain in that particular market. The European Commission has imposed tariffs of up to nearly 38% on Chinese-made EVs.
And French elections still in focus as citizens prepare for the second round of voting. Let's check in with our reporter Ndao Lechela and the DW team for more insight on these elections.
Well, Zinati, it's the week in between elections in France, and with the right-wing National Rally party leading into the runoffs, other countries in Europe are contemplating the outcome, including Germany. Lars Halte is with Deutsche Welle and joins me now from Berlin. Lars, thanks so much for your time. Now let's get into it. It appears Germany is among those worried about the outcome of the election in the neighboring country. Why is that?
Thanks for having me. Well, there's a whole lot of reasons, including the fact, of course, that the French have always been leaders in the European Union, and a nationalist government would most certainly change course there and likely weaken the alliance of the 27-member bloc. But as of yesterday, there's another problem that worries many in Germany. Right-wing party leader Jordan Bardella has given an interview, and that was back in mid-June, by the way, but it was only just noticed here, and he said that he would like to take France out of the European power market. He says, and I quote from that interview, "I want to go to the European Commission to negotiate an exemption from the European electricity market to get out of price-setting rules and allow France to go back to a French electricity price." Now, what does that mean? France would set its own energy policy and set its own electricity prices too, which could make power cheaper for the French. That is, of course, because France uses a lot of nuclear energy, which is relatively cheap, as opposed to Germany, for example, where energy prices are higher since the country got out of nuclear energy and decided to rely on coal and gas again, of course, in addition to renewables. Now, if the French need more electricity than is available, or if they have a surplus and plan to sell energy, they would do so based on bilateral trade deals yet to be negotiated.
And why would that be a problem for Germany, Lars?
Well, because electricity would become a lot more expensive here. France, with its nuclear power, has been selling electricity to Germany at very low prices, partially because the country's nuclear power plants are old, have long been written off, and thus they're simply producing much cheaper. Now, without deliveries from France, customers here would have to pay more. However, there are enough other suppliers to at least secure energy supply in Germany, that's for sure, because we're also buying from Switzerland, Belgium, Denmark, Norway, and the Czech Republic, just to mention the largest suppliers. Now, one problem is where electricity is needed and where it's delivered from. There are parts of the German southwest that do kind of depend on French energy. Supplies imported from the north can't really be transmitted there for lack of power lines. It's just too far. So we might have to produce yet more electricity from coal and gas, and that has an environmental price too.
And how likely is this scenario of France creating this kind of problem for its neighbors?
It's not very likely. The EU power market is, of course, strictly regulated and is all written in, maybe not stone, but in very long-term contracts. And one EU member state could not just quit and get out of these contracts. They would certainly be subject to lawsuits in front of the European Court. So for now, Bardella is saying he wants to win special approval from Brussels for the country to be exempt from the market. It's of course extremely unlikely that such an exemption would be granted, lest others follow suit. So it does seem that much of what he's saying here is simply a way to make headlines and win votes from those people who have long criticized the EU anyway. You'll find these people in France, as you can find them in any of the other member states of the bloc, of course, but they're likely not a majority.
Lars, let's leave it there. Thanks for your time and insights. That was DW's Lars Halter. It's back to Zinati now with your markets update.